Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to episode 76 of Carson's Facts versus Feelings with Ryan and Sonu. This is take two. So this is episode 76 again. We're talking, this one is Anyone Bearish. I messed up the title a second ago, so we're going to do it a second time. So there's a lot of fun stuff to discuss here today, Sonu. But first things first, with the hour change, how is your household doing? How'd the kids do this morning? How are you doing? It's only 1 hour, but how much has it messed everything up?
So I'll just say this at the top, but I hate this, time shifting. And the first 6 years I was here in the States, I was in Indiana where we didn't shift times. So it's when I moved to Chicago, it's about 18 years ago or something. But yeah, that's when he started shifting. I was like, what the, whatever. No, it's ridiculous. I hate it with a passion. Every time they change the clocks. And then the good part with the kids is the kids' school starts only at 8:45. Okay. And so they usually get up around 6:15, 6:30, something like that. Today they were in bed. You and I do a morning call at 7:30 a.m. on Mondays. Mm-hmm. They were in bed when I came down to do the call. So,
Yeah,
it's not too bad. And then I dropped them to school later. So
similar to most people, not a fan of it. It's nice, when you have a little more sunlight, I guess, in the evenings. But nonetheless, why don't we just keep it that way all year? I've said before, and I'll say it again. I should run for president. Maybe Sonu, you can be the VP. You want to be my VP? We're going to go on two things and two things only.
You make me Fed chair.
Oh, it's true. That's a good point. I can nominate you as Fed chair. No, you'd have more power than me then. The Fed chair has more power than the president. I can't have that. No, but anyway, I said two things we run on, right? Every time there's a Super Bowl, whatever that next day is, that Monday is off, and we call that President's Day. So I think everybody would love that. The second thing, no more daylight savings. Get rid of those. Do those two things. And I've made a joke before. I think President Reagan in 84 against Mondale won
every state, right?
Or except for Minnesota. So 49. So 49 out of 50, because that was his Mondale's home state, I guess, was Minnesota. I think we would win like that. I think we'd win 49 states, as everyone would agree with.
There was a bill in the Senate up until a few years ago, if I remember right, saying
I don't get it.
That, just to do away with the whole thing. I still don't get, is it EDT, EST, CST? I just use Central Time, Eastern Time. Right. That's it.
I don't know. We could complain all day, but it doesn't matter. It's still here. Maybe it just gives everybody a chance to complain. Maybe, we're a divided country. We all agree we don't like it. Maybe that's why they keep it, so everyone on the left and the right can agree on that. But Sonu, let's get into it. Episode 76, Facts versus Feelings. Is anyone bearish? We're going to talk about this incredible market rally. Then take a look at sentiment, because again, not too many bears left. Feels like everybody's a bull all of a sudden. So we're going to see about that, what we think about that. 15 years ago, over the weekend, the GFC ended. The Great Financial Crisis ended. I'm going to talk about kind of 15 years ago, what we were doing, what we were up to, and what we've learned from it, along with maybe a couple other things. And then economic roundup, taking a look at the Fed, take a look at gold at all-time highs, cryptocurrencies at all-time highs. What in the world's going on out there when we put it all together? But Sonu, let's just start with the rally. I mean, the rally continues. And then over the weekend, Barron's had a cover with it wasn't technically a bull on the cover, but it was bull horns.
Yeah,
right?
They didn't show the bull. It's like mine.
That's true. It's a lot like yours, actually. And that had social media in an uproar. Like, oh, that's it. It's over. We're done. Here we go. This is the bull. The bull market we've been in is over now. I'm not so sure about that. But I mean, listen. It's a lot different than a year ago when we had the regional bank crisis. You and I were talking about why we should still be bullish. We actually added equity risk later in March last year when everybody else was selling, saying the end was near. Now people seem to agree with us. Where do you want to take this conversation? But I think it's an interesting one.
Actually, let's talk about the covers, because I know you've looked at it. Let's talk about the magazine covers, because it's always like, it's a contrarian indicator. So tell us how much of a contrarian indicator it is. Does it matter which magazine it is in the first place?
Yeah, well, good points there. I'll say this about Barron's. Barron's has been very, very right. They've had a lot of bulls over the cover the last 10 years, and I mean, it's not like any of those necessarily marked like a major peak. I'll say this also in May of 2013. And think back, what's going on then? Well, that was for 13 years. Stocks went literally nowhere. Back, I think it was March or so of 2013 is when S&P broke out the new highs. They had a bull in the cover talking about why the stock market keep going higher. I mean, that was pretty darn accurate. Oh, by the way, late October, just last year, they had a front page, a front cover that said, time to buy bonds. Remember, bonds had a horrible year in 2022 and a terrible first 10 months last year. People said, oh, yeah, whatever. And then bonds had like one of their greatest 2-month rallies ever. So to answer this, it's somewhat concerning to see bulls on covers. We also saw The Economist a couple weeks got a bull on a cover being carried away by balloons. People say, oh, it's a bull on the cover. If you read that article, though, it was quite skeptical. It wasn't quite as bullish as it might have sounded. The Economist always kind of has a negative slant. It feels
but The Economist, you never know whether are they trying to be snarky or
I think it's snarky. I think The Economist always is kind of just, well, for whatever reason, little negative on the world. But Barron's has been quite right throwing bulls on the cover. So I'm not as concerned by that, but I will say what concerns me is a lot of the vocal bears a year ago that were yelling at you and I every time we talked about things that are positive, all of a sudden apparently is sitting right next to us in the bull car agreeing with us. That worries me a little bit more. What do you think?
No, absolutely. I mean, I guess it goes back to, what's your model of the world, right?
Yeah.
And you want to be right for the right reasons. And, which is not to say you can always change, you want to change your opinions if the facts have changed. There's that famous quote, right? Like, what do you do if the facts change? I mean, if I change my views, right? But yeah, but a lot of this, it's like, their model of the world for them is like, oh yeah, the recession is here. It was not even like the recession is coming. It was like the data's wrong or something. That's what they were trying to convince everyone else of. But now it's like, oh, you know what? Prices are going up. Throw in the towel. Let's just go. But I think somewhere it almost feels like the next time we get some bad economic data, which is going to happen, right? Like economic data doesn't go up in a straight line. I think the bears will be back, to be honest.
Well, that's what I was going to say. I think we need one little shakeout here, 5-7%, perfectly normal, and maybe that can get a lot of fear. I mean, even Dr. Doom, Nurelli, what's his last name?
Nuriel.
Rubini. He's out saying the biggest risk, or what's the biggest risk? Well, maybe it's upside to the economy. I mean, it's like, oh my goodness, where was that a year ago? When we had literally an economy that grew faster than China last year. When you look at it from a nominal basis, I didn't see that so much. So those are some things. But again, let's talk for a second about what happened on Friday, though. Friday, everything was great. Market's going up, and then a really big reversal. I want to focus on NVIDIA. We've talked about NVIDIA a lot. NVIDIA on Friday was up over 5%. By the close on Friday, it was down 5%, one of the largest intraday swings ever. We've seen these swings before, and it can mark near-term tops. So how worried should an investor be that if NVIDIA maybe has made at least a local peak in this incredible historic rally, what does that mean?
I think, it's time for a pause, right? But things have, NVIDIA's run up. There's that other, what's it? Supermicro computer.
Supermicro.
That's another one. That's done even, twice as much as what NVIDIA's done.
Yeah.
So all of this stuff has run up. But at the same time, what's interesting about this, along with all the bullish sentiment right now, you're also getting the whole bubble talk, right? You and I talk, it's like, oh, is it a bubble now? Is it a bubble now? And, just up until a couple of months ago, everyone was like, it's only 7 stocks going up. Now it's like everything else is going up. So maybe it's a bubble instead. It's interesting how fast narrative shifts in markets.
Well, great point. You look at we've talked about this before, but the S&P 500 equal weight, like over the past month or so, it's outperformed the S&P by a couple percent, right? I mean, that hit, I believe, 7 weekly highs in a row, 7 weeks in a row on the S&P 500 weekly equal weight. So again, it's not just 7 stocks. And as we've talked before, it seems like Apple kind of got kicked out. Tesla got kicked out. Now I guess there's only 5, although maybe Supermicro took its spot. I don't know. Supermicro took its spot. I can't keep it straight. But I mean, you pointed out on a call we just did with our partner this morning, Carson Partners, that like 8 of 11 sectors were higher last week, even though the headline S&P was down. Oh, my favorite, by the way, worst week for the Dow since October. That was the headline on Friday. And even this morning on CNBC, you look, it's like down like, I don't know, 1%. I mean, it was like, oh, well, that's really not as bad as it sounds.
Thank you very much.
Yeah. Okay. After that rally, a little more
No,
Go ahead. Go ahead.
no. I was just saying it's interesting. Like the Nasdaq, the Dow, the S&P 500 were all, slightly down last week. But you look everywhere else in the investment universe, and most of those indices, a lot of them were up. It takes mid cap stocks, small cap stocks,
Yes.
whether growth stocks, value stocks, tech stocks, small on the small side, industrial stocks on the mid side, everything was up.
Well, exactly. We've talked a lot about small and mid. I mean, mid is this quiet group that continues to just outperform, yet no one's talking about it. Everybody's small caps, large caps. It's like mid caps are quietly outperforming, which is something I really like to see. The S&P, by the way, it just missed being up last week, which would have been 17 of 19 weeks higher. But as we sit here, it's up now 16 out of 19 weeks and up about 24% those previous 19 weeks. I mean, that's like never happened in history. We've never had a 16 out of 19 week higher up that much. Now, I will say, I looked, Sonu, we had 20 times where the S&P gained at least 20% in 19 weeks, like we just saw. 6 months later, S&P was higher 19 out of 20 times. A year later, S&P higher 18 out of 20 times. That's after a 20%, at least 20% rally in 19 weeks. You see that continued outperformance. So we're overweight equities. We have been, since December of 22. People hated it then. Now they're all of a sudden agreeing with us. But nonetheless,
they're all looking at the same table, right? It's your fault. You're putting these numbers out there.
Well, they're catching on. About time. But nonetheless, But nonetheless, a bigger picture, we're still optimistic. But it is, a little concerning, I guess, when all these bears are jumping on the bullish bandwagon. Anything else you want to touch on, Sonu, markets-wise or magazine cover-wise before we move forward?
I mean, some of these numbers I was looking at, like going back to, we were talking about the Magnificent Seven with it's Apple, Microsoft, Google, Meta, Amazon, Tesla, NVIDIA, obviously the big one, right? But it seems like now everyone's like, oh, maybe it should be the Mag 4, or maybe it should be the Magnificent 3 or 5. But what's amazing, like you look at something like Tesla. I was looking at how far away from all-time highs it was. It hit its all-time high in November 2021. It's down 57% since then.
Wow.
Amazon, it hit its high in July of 2021. It's down 6% since then. It's not as much as Tesla, but it's still, you're talking about the market being at all-time highs, and Amazon and Tesla are not. Google is down 12% from its all-time high. Apple is down 14% from its all-time high, right? So, by the way, I have to ask you too, why do you hate Apple?
Well, I wouldn't say I hate. I hate. I don't know.
Not the stock.
Yeah, I mean, so for whatever reason, when people started getting smartphones, I just didn't want to get an iPhone because my wife had one, everyone else had one, so I just went the Samsung Android route, and I've always just kind of stuck with the Android side of things. Now I'm a Google guy, Google phone, Pixel, and I've just always been that way. So yes, everyone in my family has an Apple phone. I feel like everybody I know has an Apple phone. I'm the guy on the text string that when you send like a video, it doesn't look as clear, it comes in all pixelated because Apple and Google don't talk to each other. So yeah, I don't know. I just go by nature. I'm a contrarian, I think, is the bottom line. And I just kind of said, everybody's jumping in that boat. I'll take this road less traveled, so to speak. But yeah, so obviously, just it's interesting again with the sentiment. I mean, real quickly, some of the sentiment polls are showing a good amount of bulls, a lack of bears. Put to call ratios are quite complacent. That doesn't mean the market has to just collapse. I mean, we're going to see a bear market. We don't think that's the case at all. But a standard, I mean, listen, we've talked about this a lot, but your average year sees like it's like 7 separate 3% pullbacks a year. You see at least 3 to 4, 5% mild pullbacks a year. You see 10% correction on average a year. Doesn't mean it has to happen every year. We saw, just last year, we saw an 8% pullback around March. Right about now, we saw a 10% correction into late October. Really scary both times if you look at what was really happening out there. Yet we gained 25% for the year. So I think it's important to remember these last 19 months, we've been really spoiled. It's been great. Don't complain, but just be aware it's probably not always going to be that easy. Anything else, Sonu? You want to move forward?
No, we can move ahead. I mean, actually, I have one. We're talking about sentiment switching to being bullish, but it doesn't seem like there's euphoria there. It doesn't seem like everyone's gung ho. I know Bitcoin's going up and all of that stuff, but it doesn't seem like everyone's gung ho about, we need to go out and buy equities. Like, what's strange is if you think back to 2020, like April of 2020, I remember like there were so many people like like which stock should we buy? I mean, that was the middle of the pandemic. Maybe it was because everyone was at home. They were like looking at the brokerage accounts. So it doesn't feel like that right now.
No, you're right. It really does not. People know what I do for a living. They probably know what you do. They know what you do for a living. I'm not hearing people reach out to me and say, wow, market's at all-time highs. How high is this thing going to go? I mean, I don't get that, right? And you probably don't either.
No.
So it's a real good point. And again, I mean, we've talked about this one before too, but I think it's important to note. Alan Greenspan, I think it was December 12th, but December of 1996, he gave his irrational exuberance speech, in essence saying, hey, this is feeling a little frothy. It's feeling a little bubblicious, right? Yet, what happened? The stock market had one of its greatest rallies ever in 97, 98, 99, into early 2000. NASDAQ virtually doubled and doubled and doubled and doubled again. So again, we're not calling this a bubble. I think we're going to be very clear, but at the same time, we are saying, sometimes these things can continue to go, and we think we're in a major structure. We'll talk about the economy here soon, why we're bullish the economy. But again, there are some parts of the economy that are frothy, and let's be honest, we talked about before, the Mag 7, just the attachment and the excitement around the Mag 7 and what's happened, rightfully so, that kind of feels a little bit like over the top. And then you look at the reversal in NVIDIA and some of the other ones just kind of breaking down, and it all adds up to, again, maybe just some concern. But one final comment from me here. I'm very impressed with you told me Apple will be down like it is, Tesla will be down like it is. Oh, by the way, expectations for interest rate cuts would have been drastically less than they were 5-6 weeks ago. Yet the market's like flirt with all-time highs. Small and mid caps have led. I would have been very surprised, to put it mildly. And that's happening. So again, the message of the market is where we care. Oh, the other thing is that regional banks, so they've struggled. Yet large cap banks are doing great. We're overweight financials. We have not really liked the smaller regionals because they've got some structural problems. Yet again, small caps are doing well. There's a lot of regional banks and small caps. Yet small caps are doing well. Imagine if they kind of clean up some of those problems in regional banks. And that's a lot because of biotech and some other areas. I get it, but we get it. Still, there are some real positive things happening. All right, Sonu, let's see here. You know me, I scribbled a bunch of stuff down. Oppenheimer, it won 7 awards last night. You saw it. Did you watch the Oscars by chance?
I did. Not all of it. By the time I tune in, it's like, the last hour, which is probably like director, picture, best actor, best actress. That's what's pretty much left for the most part. But it was good. I've seen only, my wife and I usually try to catch most of the movies, but this time we've seen only Oppenheimer. And, so. I'm not surprised it swept. But I honestly haven't seen the other movies to make a judgment one way.
Well, and that's the joke. Like everybody saw Oppenheimer, everybody saw Barbie, right? But I mean, like the other movies, I'm not so sure I saw those. I saw Oppenheimer in the theater. Yeah, it was amazing. You just kind of said, oh, well, yeah, they're going to win a bunch of awards. I wasn't quite the fan of Oppenheimer. Maybe that's my nature to go. I mean, like I said, I'm an Expendables type of guy or the Beekeeper type of guy. Yeah, Beekeeper. Expendables 4 was terrible. We talked about. But anyway, so congrats, Oppenheimer. And well deserved. That was pretty neat.
I think
pretty neat movie.
Actually, I should say this I think it's the first one in years where the Best Picture has actually made a whole ton of money. Like it was a box office hit, but the rest of them were barely I've seen a few of them, but they barely made headlines. Right?
They're too artsy. Those low budget ones are too artsy. I'm not. Don't give me that type of thing. But all right, so let's see. So we're going to talk 15 years ago. 15 years ago on March 9th, 2009, the Great Financial Crisis, bear market of 57% drop in the S&P. I mean, most banks were down 80 to 90%, some down even more. Ford Motors bottomed at $1, right? And I think a couple other, Fifth Third. I'm in Cincinnati. Fifth Third bottomed at like $1. And these are like iconic companies. And then we know, I mean, if you were there 15 years ago, you remember it. Sonu, what were you doing during the financial crisis? Where were you in your career, your life at that time in 2008, 2009?
I was modeling derivatives, options. So it was
what a time. It's like 19 Sigma event. Here it is. I mean, talk about stuff that's not supposed to happen.
I mean, volatility was high, which I should note. I mean, I won't go deep into that stuff, but it was a good period from that perspective in terms of like when vol is high, if you're in the options world, it's not too bad, right? So
sure.
If anything, it's the opposite. It's when there's no volatility, things can get like, you're not making money at that point. But no, 2009, I remember pretty much the only person who was bullish. I mean, I didn't know you at the time, so I think it was Warren Buffett. I think he came out, and speaking of options, he'd written puts, right? I mean, basically, when you write puts, you're basically saying that you're writing insurance, right? I mean, nobody wants to write insurance in the middle of a hurricane, and that felt like Warren Buffett was doing that at that time. So again, goes to show that that was a different world. We're a long way away from that. 15 years. It feels like there's always something in March.
Yeah. It's true. I mean, March has been wild. Back to that period though. It's October of 2008, right? That's when a lot of that's everything. The wheels really started falling off. Most stocks bottomed in October 2008. Had a little bit of a rally. Then early 2009, the wheels fell off again. Made new lows. The devil's sign 666 S&P 500 in March of 2009. But most stocks did not violate their October lows. Yes, clearly some of them did. Mainly the financials. Kind of similar to kind of the last bear market that we had. We talked about that, right? A lot of stocks bottomed June. More stocks bottomed in June of 22. Market rallied a little bit, then rolled back over into October 22, but less stocks made new lows. And I think at that time, I kind of pointed this out, right? October of 2008 and then March 2009, that's kind of how major lows form. But Sonu, since then, since March 9th, with some help
of 2009.
Yeah, March of 2009, total return basis, S&P 500 is up over 900%. I made the joke. Yeah, if you would have told anybody 15 years ago right now, what would you give to be up 900% on a total return basis 15 years from now? I think a lot of us would have given an awfully lot, because at that time I would have said, heck, 5% 15 years from now would have felt pretty good, because it really, really was a scary time. What do you think of that?
No, absolutely. I mean, obviously, I'm in markets, I follow markets. I don't think if you'd asked me what's the total return from that day, March 9th, through whatever, last week, I don't think I could have come up with that 900%. Maybe I'd have come up with like 300 or 400, literally off the top of my head, right? But so even though I literally know the S&P is at 5,000, at that time it was 666.
Yeah, there you go.
So you can do the math in your head. But if you just Sonu off the top of your head, what do you think? I wouldn't have said 900%.
No, exactly. I mean, I was working at a small research shop in Cincinnati at the time. Like every Friday, like a couple people get pulled into the office. It's like, oh no, here he goes. There she goes. It means you're getting canned. And it was just unbelievable. I mean, it was truly scary. My wife at the time worked for like a hospital, and it's just interesting at her world of like working in a hospital, like nothing changed, right? I mean, you kept going to the job, but in financial world, it was, I know a lot of financial advisors probably starting off in their careers or younger in their careers 15 years ago. And it was, let's just say this, hopefully it was unlike anything we're going to see in our lifetime. But here's the really wild thing. So 900%, that's great. Was it easy? No, right? In 2011, 2018, we had near bear markets, almost 19% corrections both those times. Oh, we had a 100-year, 100-year pandemic with a 34% bear market in 2020, followed by another 25% bear market in 2022. And there's some other periods of volatility, but to think this was just an easy 900%, no. I mean, people have been scared the whole way up, and I've said this many times, but the stock market's the only place things go on sale and everyone runs out of the store screaming. For 15 years, we've been seeing people run out of the stores screaming. I think it's just really important to kind of remember from a bigger picture, longer term point of view. The next time we have a lot of fear and scariness out there, think about 10 years from now. Think about 15 years from now. Will it be higher or lower? Well, let's just put it this way. Hopefully it's higher, or something really bad's happening. What do you want to add there?
No, it's going back to, like, we've had Professor Jeremy Siegel on the podcast. He said, historically, real returns have averaged 7% over time. And you look at the last, forget just 15 years. Look at the last 30 years. From 94 on, we've had the dot-com bubble. We've had the dot-com crash. We've had the housing market bubble. We've had the crash. We've had Greek debt crisis, China, all of that. The pandemic then. You had so many bear markets. The market's done 7% in real terms after adjusting for inflation over the last 30 years.
Wow. I mean, yes, it's just, we do this for a living, but when you take a step back and think about that, it's just so important for especially younger investors. I know we have a lot of people. I mean, we've hit some huge numbers on this podcast. Thank you to so many new listeners. A lot of young people listen to this. I think it's, you listen to all these old guys are talking about this stuff. This stuff's all happened before, right? I mean, this has happened before. It's going to happen again. There's going to be scary things. We're going to sell off for whatever reasons in the news and whatever legit reasons happening. But if you're looking at your retirement and you're relatively young, Boy, oh boy, use these as opportunity. I will say, so my 140-pound Great Pyrenees, Walter, just came down. Oh, you can't see him. He's right. I'm scratching him. He just ran down the steps. I'm just scratching him, doing a podcast, scratching my dog.
It's like, this is the time. I need to get his attention.
Animal friendly podcast. Yeah. So let's see. Anything else about the GFs? How about this? Right, you didn't see this come at all. Any movies that you like? I'll go first. Give you time to think about it. Any financial from that. I think Margin Call. I think Margin Call is a really, really good movie about that period in time. Just all the crazy stuff that happened. Of course. Oh my God. What the Big Short? The Big Short. Big Short's funny. I mean, Big Short's a great one too. I watched that not too long ago, and it's like, oh wow, those two stand out. Anything else stand out movie wise that people should maybe check out if they want to think back to that really fun time in life?
Well, I like The Big Short. I actually read the book. And then watched the movie. And then there was Too Big to Fail, which was a little more like inside baseball with Andrew Rohr Sorkin. They made I think an HBO movie about that. But then, even outside of the financial crisis, actually, I like Trading Places. So that's a nice one, old one. And then actually bookended by something I saw recently. I think I talked about it. Dumb Money, about the whole GameStop thing, right? So
yes.
I think that was fun because it was very different, because a lot of financial movies are about trading and things like that. This is like a bunch of people sitting in their basement and making money, and they're going up against these big hedge fund guys. So there was, there's something interesting about that.
Absolutely. Those are great. And then, of course, the original Wall Street, which if you think back to that, that's a great movie. I mean, great movie. But like the Masters of the Universe, like all the power in the world's on Wall Street, Greed is Good, all that stuff. That came out in 87. Okay. Like a peak, right? A pretty significant peak. We know that blow off peak. And then Wall Street 2, and I forget exactly when it came out, but it came out like after the financial crisis, sometime 2011, 12-ish. But it had like a negative slant to Wall Street. Remember how this one was? It was quite a negative slant to Wall Street because they just had this implosion, right? And people felt a certain way. People are angry about what had just happened because Wall Street made me lose my retirement. Wall Street made me lose my job. And believe me, I'm not disagreeing with you. There was a lot of anger, but it was from a contrarian point of view. Masters of the Universe made a major peak, and then when they had this negative coming off the crisis, then 13 came, new highs, and just off to the races literally for 7 years. We understand COVID things, but it's really interesting from that point of view. So to everybody, Sonu and I gave you some homework. Go watch some movies. If you haven't seen those, you will learn probably more sitting down for 2 hours on some of these movies than anything you could do outside of living through it. Like I didn't live through the 87 crash. I guess I did. I was a young kid. I didn't even live through
the .com bubble crash, actually, to be honest. I mean, I knew what was happening, but it didn't register. I mean, that's when I went to the grad school. If I was looking for a job, I think I would have been more worried.
That's where I got the bug, was in late 99. I always liked math and numbers. I thought I'd try accounting. I hated accounting. I didn't care about accounting. I realized real fast that's not for me. But my dad gave me some play money and quickly made a lot of money in the stock market. Everything's going up. Oh, they mentioned, Juniper Networks or Cisco on TV. Oh, you just buy it in your little E-Trade account and it goes up. It was simple. It was easy. Kind of like 21, the meme stock, kind of a little bit like that. But then, of course, I was on margin. I had no idea what margin was. I just know every day I'm making more money. And then everything crashed. I literally lost like all of it, but I was hooked and I realized, I could have made money on the way down. There's value. There's something called a value stock that actually did okay in 2001, 2002. Yeah, small cap. Oh, I thought I only had to buy, the biggest growth name. I didn't know. Young. Listen, that's the way we pay the piper. You got to do that. But I was hooked. And again, these bubbles and bull markets and bear markets, they've happened throughout history. They're going to happen again. Good news as we laid out, and we're going to talk about next year. This is a bull market. We don't think we're anywhere close to the major peak. So Sonu, two other things that I want to point out here. St. Patrick's Day is around the corner. Yeah. Are you going to swim in that green? Are you going to get all liquored up and swim in that green? What's the river in Chicago they make green?
It's the Chicago River.
It's just called Chicago River? Even I could remember that. You going to swim in that all liquored up on St. Patrick's Day?
I wouldn't swim on that on my most liquored up day ever. It's hard enough kayaking in that thing, river. No, it's apparently the water is not toxic anymore, so...
Oh, well, that's wonderful.
It's one notch above toxic, I believe.
It's a bull market, and the water is not toxic in Chicago's river anymore. This is 2024 is a great year.
No, look, I've never taken my kids out to see that because it's crowded. A lot of drunk people, and my wife is like, "Are we sure we want to take them?" This year, we are planning, let's just take them, just get a little bit of the atmosphere and see the green maybe I'll do a take 5 or something from there.
Ooh, I like that.
I'll put the Green River behind me. I mean, hopefully it's not too cold. It tends to be cold that morning, and then there's a reason everyone flickered up. So
yeah, well, so they don't notice it as much apparently. Speaking of which, so what was I going to say?
What about you?
Oh, well, yeah, one more on that because this interests me. Is there a lot of Irish people in Chicago? I mean, is that why they do? Yes. It's clearly such a big deal. There's a lot of Irish that made its way to Chicago. Is the rationale there?
South of downtown, there's a whole area is historically Irish area. So
got it.
They have a big parade, all of that. I did one time. This was before the kids were born. I did meet our former governor. Who a lot of people may recognize, Rod Blagojevich, who went to.
Oh yeah.
Yes, I know.
Oh yeah, I know that. I know that one. Yeah, How about that?
Ended up.
Of course, he's from Chicago. Of course, he's from Chicago.
Governor of Chicago. No, governor of Illinois. Sorry, not in Chicago. Governor of Illinois ended up going to jail. Got a pardon from Trump. So came a full circle. Anyway, I met him at a St. Patty's Day parade one time. Literally just shook hands. That's it. That's my St. Patty's Day story.
Yeah, I don't think we'll do too much for St. Patrick's Day. Honestly, I don't know. It's there. I mean, I will say this past weekend, my uncle, it was his third marriage. My uncle's a lot of fun. We got a big party bus, went out for his bachelor party. So I had a few. Right. I had a few. I don't do that very often anymore. We had a party bus and went out and went to like a Top Golf and had a lot of fun. Nice. And I was moving a little slower than normal on Sunday yesterday. I'm back today. But yeah, I don't do that ever anymore. But it was fun. It was a good time. And like we joked, this is his third bachelor party. By then, hey, anything happens. So it was a good time had by all. The last one's Pi Day, 3/14. How are you going to celebrate Pi Day?
Wow, pie.
Yeah, eat some pie. I was thinking, cherry, apple. I don't know.
I didn't really think about it, but it's actually 2 days after my mother's birthday. My mom's birthday is tomorrow. There you go. So happy birthday to her in advance. She's in India. But Pi Day always comes. One thing I did, was it last year or 2 years ago? So you can convert these numbers, 3.14, all that into musical notes. So I think for my kids last year, I was like trying to play that on the guitar after converting those numbers into musical notes. So it actually comes out in a fairly interesting tune. So.
No, that's neat. I've heard different bands have used variations of pi before, and apparently it works, right? It's all in nature. I mean, some of those videos on the Fibonacci sequence. Go to YouTube, type in Fibonacci sequence. The way it's all in nature. Oh, and believe me, you're getting a little in the weeds, but since we're talking about this, I didn't know this was going to happen. But if you go from the lows of 82 for the S&P 500 to the peak in October 2007, a very common Fibonacci retracement is 61.8. Take a wild guess what 61.8% is from the 82 lows to the 2007 peak. If you overlay that, and you can do this very simply on a lot of charting platforms, stockcharts.com is one I like. You can look at right there. 61.8 is 666. Okay, so literally to that day, I remember that day came out. A lot of technicians were talking about this. I was quoted in a Bloomberg article on that day when we went down there of a 61.8% retracement of the bull market from 82 all the way to the peak. And I was like, I didn't necessarily believe it, but listen, Fibonacci, my head explodes a lot of times when I hear some of those things. But when I saw that, I was like, oh, well, maybe sometimes this stuff's a little big,bigger than all of us when that actually nailed the lows.
618, half of that is 314.
You start getting around. It's neat. All right. So final thing we want to talk about the economy, the Fed and gold, economic roundup. I guess let's talk a little bit about the jobs number and the productivity number from last week. Then we'll talk a little Fed, a little gold, and kind of see where we go with it. But let's start with that jobs number, Sonu. Once again, pretty solid, right? Yeah, no, exactly. I mean, the only thing that surprises me is that everyone keeps getting surprised. One way to put it. That's look, we got another big headline number for payroll, 275,000 in February, but immediately it's like, oh wait, January and December were revised down a lot. Yeah. They were revised down 147,000, right? So, but that's why you look at the 3-month average. The 3-month average right now is at 265,000 jobs per month, right? That is the highest since June of last year. And just for perspective, okay, what is 265,000 jobs per month? Well, put that in context, right? 2019, which is a strong economy, average monthly job growth was 166,000. So 166,000 is strong by itself, right? Yeah. You're about 100,000 above that. Even if February gets revised down, which is likely,
But let's say it revises down and we're looking at a 3-month average of, I don't know, like 215,000. That's way above where we were in 2019. I think that's a story there. But even the breadth, we're talking about breadth for stocks, right? You look at, okay, where are these jobs being created? People are like, oh, it's all government, it's all healthcare. No, it's not just those, right? Yes, healthcare is on top, but healthcare lagged when the recovery was happening in 2021 and 2022 in terms of the employment market recovery, right? But look at other cyclical sectors like leisure and hospitality, 58,000 jobs created. Construction's a big one, right? Construction, a very cyclical part of the economy. Construction created 23,000 jobs in February. Last 3 months, Ryan, 60,000 jobs. Last 6 months, 110,000 jobs. Right? Like, you know, we're not having a recession. We're not close to a recession when construction's going, you know, gangbusters like this.
And I know you've talked about the construction strength before, yet we've talked a ton about, you know, your PMIs and your ISMs consistently beneath 50. What these survey managers were, these managers are saying, like 300 surveyed managers, okay, that's their opinion. But then you look at literally hundreds of thousands of companies out there, what they're doing. Well, the hard data has been saying the whole time construction was likely in much better shape than, and manufacturing much better shape than what the surveys were telling us. And again, you wouldn't be hiring, I don't think, would you say 100,000 people the last 6 months? 110,000 the last 6 months? Maybe wouldn't do that if you weren't so comfortable about the economic expansion. Now, let's dive into a little bit on the household survey, which again, 3.9%, still beneath 4. I mean, it's 25 months in a row beneath 4%. But why did that spike?
Rate,
the unemployment rate, 3.9%, the highest number in a while, still beneath 4. Why did that spike? You looked into it. It was kind of interesting.
Yeah, so we have 2 surveys for the payroll survey, or payroll report, right? One is what we call the establishment survey, which is, you know, they take a survey of businesses, 150,000 of them, a lot of them, right? It's a bigger sample. The household survey is actually smaller. It's a sample of, well, households, right? It's about 50, 60,000, something like that. It is more volatile. And they say the tolerance, the statistical significance, right? There's a plus minus confidence band. It's about 600,000, by the way, for the household survey in terms of employment numbers. So it's noisy. Okay. It's useful for ratios, which is why the unemployment rate comes from that. 3.9%, It was up from 3.7%. But that was almost entirely because unemployment rate for youth, 16 to 19-year-olds, went up from 10.6 to 12.5%. For 20 to 24-year-olds, it went up from 5.9 to 7.2%. And by the way, that's still in line with what we were seeing pre-pandemic, even though it went up last month. But you look at everyone else, 25 years and higher, right? Although even including older people above the age of 55, the unemployment rate was 3.2%. That was unchanged from where it was in January.
Wow. Yeah. So good stuff there. I mean, so younger people, I mean, more volatile for sure.
Yeah.
I made the joke. Maybe they just made a bunch of money in crypto and they say, you know what? I'm done working. I mean, who knows? But the bottom line again is things look good. You want to talk about the participation rate a little bit?
Let's. The opposite of
let's wrap it up with that. Let's wrap up participation rate.
Yeah. So the opposite of the unemployment rate. Unemployment rate. What are you doing? You're looking at all the people who are unemployed as a percent of the labor force, right? And now the problem with the unemployment is, you know, the way the BLS defines it, like you have to be actively looking for a job. And then you get into definitional, like how do you measure that? Or like how exactly is that counted? Are you actively looking over the last 2 weeks or last month, 1 month, things like that, right? A better approach, I feel, is just look at total employment. How many people employed as part of the population, as a percent of the population? That's the employment population ratio. And then we're an aging society. To account for that demographics, you look at prime age, right? Between the age of 25 to 55. That prime age employment population ratio went up from 80.6% to 80.7%. That is higher than at any point between July of 2001 and February of 2020, before the pandemic.
Wow.
For women, Ryan, it is at 75.2%. That's pretty much a historical record. Actually, that record is 75.3% from last year. Between June and October, we had like one tick below that, 75.2%. But that's higher than what we've seen at any point before the pandemic.
Wow. Yeah, no, that tells a powerful story. One that I know you've talked a lot about is following the participation rate. I'm trying to think if there's anything else.
Actually, I'll pick one. I mean, because people like, oh, look at multiple job holders. That's going up, right?
Yeah, that's a good one.
That's a big one. Like that's another knock on this labor market, like, oh, look at the multiple job role that's going up. Yes, that's going up. But by the way, that happens only if the labor market is strong. If the labor market is weak, forget 2 jobs. It's hard enough to find 1 job. Right. Whereas if you have a strong labor market, there's more opportunity to make a little more money. A lot of people worked out, 2 jobs. But even if you look at multiple job holders as a percent of total employment, that's at 5.1%. By the way, that's exactly where that number was in February of 2020 before the pandemic.
Oh, wow.
Right.
Okay.
So just to put some of that in context as well.
Well, good stuff there. I guess the final thing is wages, right? We saw a big jump in wages, 0.6% back in January last month. And we said then, you rewind a few podcasts ago, we said, well, people didn't work as much, maybe simply, and so they didn't work as much. The wages were a little bit higher because it was cold outside. People didn't, if you worked outside, you didn't work, or it's just a little cold, maybe you didn't go to work as much. The bottom line, that 0.6 was revised down to 0.5 for January, but hourly wages were up only 0.1% in February. So that came back to earth. Anything to add on that one, Sonu, before we wrap this discussion up?
It goes back to, again, this is why you take a 3-month average. Over the last 3 months, at an annualized pace, wage growth is running at 4% for all workers. Even if you take out managers, right? So production employees and non-supervisory employees, that's running at 4%. Before the pandemic, it was running between 3 and 3.5%. All that to say, it doesn't look like we are in a red hot overheating type labor market, which should worry the Fed, right? So in terms of like wage growth promoting inflation or leading to higher inflation, I don't think we're in that sort of situation. So, and look, at the end of the day, what matters for the economy? It's consumption. Consumption comes from income. Incomes are growing. Overall aggregate income, right? Product of employment, wage growth, hours worked. That's running about 4.7% right now over the last 3 months, annualized rate. It's pretty much where we were in 2018, 2019. So again, like I said, tells you we shouldn't be too worried about inflation surging again because of, strong income growth.
What well said there. Again, this is episode 76 of Carson's Facts versus Feelings with Ryan and Sonu. Help us out by telling us how we're doing. Leave a review, give us a like, and subscribe if you want to hear the latest. Good stuff there. Let's see here. Productivity. So one of the key concepts we've talked a lot about is productivity. One of the keys to higher productivity is, I guess I'll call it an aging employment backdrop, which we're seeing. Things are slowing down a little bit, like you said, but that's healthy. So no, fourth quarter productivity was 3.1%. They just revised it to 3.2%. We've averaged 3.7% the past 3 quarters. That's the strongest 3-quarter rally we've seen outside of a recession since the mid to late 90s. And also labor costs dropped drastically as well. So, it's almost too good to be true almost, but talk to me about productivity, why it continues to be so strong.
Basically because we have a tight labor market, right? And we've seen that in little pockets of the data as well. You take one big difference between what's happening now in the labor market. It's still strong, but it's not as hot as it was a year and a half ago, even a year ago for that matter, right? At that time, there was a lot more churn in the market. Right, there are a lot of people quitting their jobs. Why do you quit a job? Hopefully to get higher pay, right? And so that's why overall wage growth is running really strong. That's come down now. I think a lot of people have sort of settled into their jobs. What happens if you stay at your job for longer? Well, hopefully you get better at it. You get more productive at it. You're producing more in the same amount of time, right? So that's basically productivity. And I think that's what we're seeing in the aggregate numbers as well. Productivity has gone up, as you said, 3.7%. Annualized pace over the last 3 quarters. And what that allows is, this is where all of this stuff connects to monetary policy and the Fed. It allows inflation to stay muted, right? You can have strong wage growth. Usually that's like the Fed worries about strong wage growth, like, oh, that could lead to higher demand and more inflation. No, not if you have higher productivity. And that's basically what the story has been over the last few quarters.
Yeah, that's something you've talked a lot about. One of the reasons we've been optimistic about the economy, stock market, strong consumers, inflation, a cap on it. And oh, by the way, the Fed, the door is open for some rate cuts, potentially this year. And we're not super worried it's going to cause a lot of inflation because, again, history didn't repeat itself. It often rhymes. Mark Twain, mid-90s, we saw a period where the Fed was able to cut. Wages remained high, around 4 to 5%. Inflation was, 2 to 3%, maybe closer to 3% back then. But again, inflation was capped shift, and productivity was a big key theme to the whole thing. Also, we have new business applications have simply been soaring relative to where the last previous cycle, which is really good. Also, record CapEx is expected this year. Oh, by the way, AI, which maybe isn't even showing up yet, that's coming too. All these things smushed together with that aging labor force to us suggests, Sonu, here's one. So we've had 3 quarters in a row of good productivity. How long can this last? Of all these things I just mentioned and some other stuff, how long can we see good, strong productivity go, you think?
I mean, just historically looking back, I mean, at least the data, 96 to 2004, I was looking at the numbers.
Okay.
We had productivity growth averaging about 3% per year, 3.1%. And at the same time, wage growth was running at 4.5%, which by itself would be like, oh, wait a minute, that's strong, right? But wait, from 96 to 2004, inflation was running about 2.4%. So inflation is muted. Why? Because productivity was high. And by the way, it's actually productivity growth is, obviously it's good for workers and wage growth and all of that. Keeps inflation lower. So that's where the Fed comes in. But it's also good for margins. I mean, a lot of time we see during highly productive periods, some of that productivity, those productivity gains are taken by companies in the form of margin growth, right? So it's good for the stock market as well. Just from that perspective, forget the economic perspective. I mean, wages are strong. Obviously, that's good for the economy. But even from just a more narrower sense of looking at company financials, right? I think on an aggregate, margin growth rising is good for stocks. And, we've seen that when productivity is high.
Yeah. Oh, we've been seeing that. I mean, for the past year, we've seen a slow and steady trickle higher in profit margins. Most people didn't expect that to happen. But again, if the productivity is there, like you said, it's happening. 2 other things we'll hit on quickly last week that took place. The State of the Union. Honestly, I don't think President Biden shook things up. But here are some interesting stats from our good friend, Libby Cantrell, who joined us last week on the Facts versus Feelings podcast. It was 1 hour and 7 minutes, which is actually fairly standard for a State of the Union. It was shorter than President Trump's historically. In fact, President Trump's longest was in 2019. He went for 1 hour and 22 minutes. Wow. The longest ever, 2000. I don't know. That's a major peak. So I don't know. We went long.
And somebody who likes to talk.
Yeah, that was President Clinton. Went for 1 hour and 28 minutes. The shortest ever was Nixon. And I didn't write the year down, but obviously Nixon was only president for so long. So 29 minutes with Nixon was the shortest State of the Union. I don't know. I think you and I would say, we'll go like 30 minutes. And like we always do, we'll go 2 hours. I'm looking at the time. This podcast is going a little long. We can't shut up. And also, let's talk about the Fed then. So Jerome Powell went to Washington last week. Honest to goodness, market was doing fine when he spoke. In fact, we rallied big time on Thursday. Although I think it's more of that productivity number. Whatever. Did anything he say on Capitol Hill last week surprise you?
No, he basically said, I think the second day especially, because this is cool, but the Humphrey Hawkins speech, that's a report.
There you go.
The semi-annual report he gives to Congress and the Senate. So, so first day is Congress, the House, and the second day is the Senate. On the second day especially, I think he moderated his comments, like all this. It's at the margin, right? Basically, said interest rate cuts are coming. It's just a matter of time, right? And they're coming this year. What I was actually more interesting was something President Biden said in one of his speeches where he called this.
Oh,
yes. He called the Fed, like, he was talking about interest rates. He's like, hey, folks, I think interest rates are going to come out. And he didn't guarantee it or anything like that. He said, but if I had to bet interest rates are coming down, there's this little outfit that's going to cut them, right? I was like, it's a nice way to refer to the Federal Reserve, a little outfit.
Yes, that's true. So President Biden might let the cat out of the bag that maybe a May cut is not as abnormal as what people are thinking.
I have an interesting I have an interesting anecdote about the White House politics and the Fed. Because the other thing, they're supposed to be independent. The Fed is independent. Obviously, a lot of this is political, right? It has to be. I remember President Trump trying to put pressure on on Jerome Powell. I don't know that it worked or anything like that. I think Powell would have done what he did anyway. But going back to, I think it was 84, apparently, and this was from Paul Volcker's memoirs, right? So he wrote that in 84, he was summoned, quote unquote summoned, this is the way he wrote it, to the White House. Jim Baker had summoned him. Jim Baker was, President Reagan's chief of staff. Mm-hmm. They called him, they didn't call him to the Oval Office. They called him to the library of the White House. And apparently Volcker thought they called him to the library because there was no taping system there. Remember, this was like a decade after Watergate and all that. So apparently Jim Baker told him, we are ordering you not to raise interest rates before the election. Literally, this is verbatim from Volcker's memo, right? And President Reagan apparently just kept quiet. He didn't say anything. He just let Baker talk for him. Presumably, he was in the room. He's sitting there.
Sure.
Apparently, Baker told him, we're ordering you not to raise interest rates before the election. But anyway, so just an anecdote.
Well, given Reagan won 49 out of 50 states in '84, I guess it worked. Assuming that was true. I was gonna say something else. My personal favorite part was when Kennedy from Louisiana dropped an F-bomb to you can look it up. You can watch the video. He dropped an F-bomb to
I saw that video. I didn't know what was going on, to be honest.
I don't either. I just loved it. I don't even know what was going on either, but yeah, that was pretty interesting. Final thing, and I know we went a little long. Hopefully people enjoyed this week's Facts versus Feelings. Gold's at all-time highs, cryptocurrencies at all-time highs, stock market. I mean, what in the world's going on out there, Sonu? There are a lot of things going up, right?
It's interesting, like everyone connects gold to inflation. I mean, I don't know if this is right, but I connect it to real interest rates. So real interest rates are basically nominal interest rates. When you talk about treasury yields, that's what you talk about, nominal interest rates, right? Minus inflation. And, practically you get these from treasury inflation protected securities. Real yields have been going down over the last week, 10 days, and gold's rallied, right? My logic here is, look at, if you buy gold, you have to store it. And there's storage cost. And storage cost is more expensive when real yields are going up, when it's more positive. There's an opportunity cost. When real yields are going down, like the last decade, right? When real yields are, less than 0% for the most part. It's like it doesn't cost money then to store gold because, there's no opportunity cost. So I think real yields going down, that's a tailwind for gold. That's positive. I think that's, it's a good sign.
All right. Well, that's good. We do have a small sliver of gold in some of the tactical models we run for our Carson partners. So, we're not big gold bugs, but we're not against it going higher. And we do think there's periods of time when bonds and stocks gone up together a lot, but stocks and gold have also gone up a lot over the years. And we could have another one of those periods. So, all right. So, we got a note from Chelsea that says you have something right now.
Right,
so are you a minute late? What is it? Real important? What is it?
You
better
get
there.
It's another meeting. So,
oh boy. Well, you know what? Tell me how to do the podcast. We've got a lot of friends and friends out there that demand the podcast. So with all that, we'll be back next week for another episode of Carson's Facts versus Feelings with Sonu and myself. Just a regular one. Then we've got some of the pre-recorded ones that we did from a couple weeks ago coming up with Kathy Wood and Dan Ives. They're down the pike, not necessarily yet, but they're coming. So with all that, everybody, thanks. Have a great week. Enjoy St. Patrick's Day. Stay safe. And yeah, I don't know. I'll talk to you soon, Sonu. Go get to that meeting. You're late. All right, see you, everybody. Take care. Thank you. Bye-bye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.